Hello, Eric Kulwicki. I work as an investment consultant, portfolio manager, and wealth advisor. Works with institutional clients and the general public. Just wanted to give you a first quarter 2026 market update. You can read my full commentary on kulwickiinsights.com. All right, so the first quarter of 2026 should really be viewed as two separate periods. So the year started off with a sense of optimism, with anticipation of moderate U.S. economic and corporate earnings growth, which translated into pretty strong in market environment, broad participation, and markets not just or equity markets not just led by AI related companies or speculative momentum stocks. So pretty good market environment to start the year. Then in March, U.S. and Israel started military actions against Iran. So this caused energy prices to spike, interest rates spike, just moving higher on higher inflation concerns, which translated into equity markets, precious metals, and bonds selling off. From the start of the Iran conflict, some areas of that equity market were down 10% or more from their peaks. And then from a market technical perspective, things were looking pretty bearish. So a lot of negatives for the market at that time. And then, I don't know if it was a coincidence, maybe not, but President Trump announced that his administration was having positive talks with representatives from Iran. So things are looking bearish. President announced good talks, and markets quickly reversed. So oil prices started coming down, and equity and bond markets rallied. Markets started to digest that original announcement from President Trump. So time passed, and then all of a sudden, equity markets start selling off again. So as equity markets were looking even more bearish, President Trump again said talks with Iran were productive, and then equity and bond and precious metals markets rallied into the end of the quarter. So ton of volatility. So then towards the end of March, Trump administration essentially gave Iran an ultimatum that if they didn't agree to it, the U.S. would increase its attacks on Iran. So fast forward to yesterday, actually, then right before the deadline of the ultimatum, on April 7th, President Trump announced an agreement with Iran for a 2-week ceasefire. On that news, oil prices dropped, bond yields came down, and global equities, bonds, and precious metals rallied. So last few weeks had a ton of volatility. Global markets bouncing around based on headlines and announcements, which is kind of tough to plan for, right? So if we look at the U.S. equity markets for the entire first quarter, the end of March, Q1, S&P 500, NASDAQ 100, and Dow Jones Industrial Average all declined for the first quarter. Since then, and after President Trump's announcement of the 2-week ceasefire, global equities have continued to rally from their first quarter lows. Gold had a ton of volatility in the first quarter as well. It started off with a strong rally to start the year, keeping with the price momentum that it had last year. But then momentum continued to go in late January. It started to sell off really quick, even prior to the Iran conflict. Volatility hit and gold was down almost 20% in just a couple of days. So that's what can happen when a price momentum driven rally reverses. Then gold started to rally back a little bit. And when the Iran conflict started, gold took another leg lower. But then, like the equity market, when President Trump announced positive talks with Iran, gold ended up rallying and it continued into the end of the quarter. So, like gold, as I mentioned in the past, gold doesn't always hedge assets the way some investors hope it does. Investors really should have conviction in the reasons why they hold gold. Biggest move across asset classes, which shouldn't be a surprise, in the first quarter was within the energy sector. So WTI crude rallied almost 80% for the entire full quarter, first quarter, and rallied over $100 per barrel as the conflict in Iran intensified. When conflicts in the Middle East, they can potentially disrupt energy supply out of the Middle East. It makes people nervous, and oil prices spike. Now, President Trump's administration just announced the 2-week ceasefire. Energy prices have dropped pretty significantly from their highs, but they are still higher than prior to the start of the conflict. The problem with higher energy prices is that it can ultimately flow through as cost to businesses, and then that can push these costs on to their customers. Consumers also have to pay higher prices at the gas pump and heat their homes. If oil prices remain elevated, these higher energy costs could act as a headwind for the global economy, potentially compressing business profit margins and straining consumer spending. And that can be a problem for equity markets. So that's equities, that's commodities. If we shift to the bond markets, Barclays U.S. Aggregate Bond Index, which measures intermediate term investment grade bonds, is relatively flat in the first quarter. High yield bonds sold off a little bit as credit spreads widened. To start the year, investors initially anticipated potential interest rate cuts for the year, but the sudden jump in energy prices caused higher inflation concerns. And then bond yields shifted higher, which, when interest rates move higher, oftentimes bond prices fall in those environments. So that's what happened in the bond market. If you look at the Federal Reserve, at its March meeting, the Federal Reserve kept the Fed funds rate unchanged at a target range of 3.5 to 3.75%, so no change. And at least as of right now, based on what's happening in the energy markets and higher potential inflation, higher prices, Fed fund futures are pricing in the highest probability that the Fed keeps the Fed funds rate where it is for the rest of the year, and only just a moderate chance of one rate cut this year. That can change, but that's what it is right now. Fed looks at inflation in the job market. So higher energy prices that seep into the broader economy and pushes prices up, it could give the Fed some concern to cut rates, to not want to cut rates. Job market's kind of been in a low fire environment with unemployment rate still being relatively low. So the Fed may need more to see more deterioration in the job market and the economy to more aggressively consider interest rates from current levels. President Trump recently nominated Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chairman, whose term is scheduled to end in May. Now, some investors see Kevin Warsh as someone who might be more inclined to cut the Fed funds rate, but maybe less inclined to use the Fed's balance sheet to reduce longer-term interest rates. Fed chairman can't unilaterally change interest rate policy. So regardless of what Kevin Warsh would want to do personally, he still needs to build consensus at the Fed and get majority agreement of voting members to actually change monetary policy. The tariffs are still an issue. Investors have to navigate the changing trade policy of President Trump's administration. U.S. Supreme Court recently ruled against the Trump administration's original tariff policy, which caused the administration to pivot and announcing new tariffs under different trade statutes available to the president. In an uncertain tariff environment, companies may find it tough to plan with the clarity that they want to, so they may be hesitant to aggressively spend capital, which can ultimately cause a potential headwind to the broader economy. Investors will also be keeping an eye on the November midterm elections. We're still a ways out, but it's just another variable for investors to consider, and any potential changes in government policies that could result from the election and ultimately impact the economy and the corporate environment. From a corporate fundamentals perspective, as we move into earnings season, investors should be paying attention to forward guidance from company management. Investors will like to know how companies are managing through potentially higher energy costs, evolving tariff policies, and then their investments in artificial intelligence related technologies. The One Big Beautiful Bill Act enacted last year could be supportive for businesses. Even with all the financial market volatility from the Iran conflict, current consensus analyst estimates suggest continued earnings growth in the U.S., which is a good thing, right? So if we get through the conflict in Iran, investors could return to focus on the healthy economy and business environment and then position their investments accordingly. We may have already seen some of that, right? So as equity markets have rallied from the recent first quarter lows with positive potential news on the Iran conflict, investors may be looking through the conflict and say, let's position our portfolios accordingly. Remember, investors tend to be forward-looking, and financial markets can move ahead of events actually happening. So that's it from a Q1 2026 market update perspective. As always, if you're looking for any investment or financial planning help, please reach out to me, as my team and I are willing to help. If you're looking for investment education to learn on your own, please check out my Kulwicki Insights website, and you'll find more information on the investment education courses that I offer. Thanks for the time.